Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all.
Experimentation, Ruben here. Listen, you guys know how much I love the short-term rental space. It's been one of actually my favorite guests I've had on my show, especially as an investor myself. Now, as an investor and digital marketer, I can tell you that in 2021, what is most important for every host is to establish and build your own brand. See, while Airbnb.com and Booking.com and Expedia, which we call OTAs, are good, they're not necessarily going to take your business to the next level. Or if it currently is, you're leaving a lot of money on the table. That is because the majority of hosts are not establishing their own platform, their own websites where your guests can book directly through you. If you understand anything about business and marketing, it is the ability to control a list, to have control of that list. You do not have that kind of access and control when you're relying on other OTAs. So the best and easiest way to do this is by working with Boostly. See, Boostly, Mark actually have had him in the lab in episode 130. And the thing is, they built their website specifically for folks in the short-term rental space. And they built that on a WordPress website. See, 64% of all websites in the world are powered by WordPress. While the PMSs that you may have currently are offering you free sites, they're not built on WordPress. Now, Boostly also works with your existing PMS. And it doesn't matter if you're a host of one property or 100. They can start anywhere from 99 pounds. They've helped over 600 clients worldwide. And it is so important that you tap into what they're offering and schedule a consultation call with Mark and his team at Boostly so that you can start leveraging and building your platform so you can start getting direct bookings to skyrocket your business. It's really important that you do this and start building your own brand and that you're in control of your direct bookings for your business. So if that's the case, make sure you book a call at boostly.co.uk/epic. That's boostly.co.uk/epic. And make sure that you schedule a call with Mark and his team at Boostly so that you can start getting your direct bookings for your short-term rental business. We'll see you on the other side. Real Estate Experiment, what is happening, y'all? Today I have the pleasure of having Tom Laune into the lab with us, dialing in from Nashville. Am I correct?
That is correct. Yes.
Well, first of all, thank you so much for taking the time to get into the lab. We're just, playing in the background, a little, technical difficulties, but we always make it happen. And I always say, like, what a time to be alive, right? We're able to literally dial in from anywhere in the world and still get a chance to offer value to our listeners. So welcome to the lab. So Tom, you have a very unique story. And the reason we were talking about this offline just a second ago about like, who's the avatar? And like, we're experimenters, right? So a lot of the listeners are, to put it, and I should have said this earlier, but I'm like, let's save it for the air. Experimenting is about going broad first, understanding, okay, what are my options, right? And then doubling down on what works. And I think there's no better person than yourself to come into the lab, as we call it, to talk about how you were kind of tackling a problem of your own that you had. And then you kind of went deep on it, which is what experimenting is all about. You have to go broad first and go deep. So I don't think I could have done a better job than, you can, to tell us about literally what problem were you solving initially when you got into what we call now the infinite banking specialist that we talk about, and et cetera, all that you've done. Let's talk about who Tom was before, and then you can fast forward into what problem you were really able to solve. So let's talk about it. Who is Tom?
All right. That sounds awesome. Thank you so much for having me on this show. I'm so excited to be here, and I'm looking forward to explaining how I can add value to your group and really trying to help unlock a few mysteries, because this area that I'm in now can be a little bit confusing. But I was 29 years in the music industry, believe it or not, and I was a mix engineer and producer. And 20 years ago or more now, actually, I had somebody tell me that I needed a disability insurance policy. And the thing about a disability insurance policy, it's one of the most under-owned policies that really is out there. And what it does is it protects your ability to earn a living. And around about 2013, so maybe 8 years or so ago, I started to lose, actually it was 2012, I started to lose hearing in one ear and was no longer able to continue doing that job. So I thought, you know what, I'm going to go and learn everything I can about this financial world and how it is that I've come to be in so great debt or gratitude for having this particular piece of insurance on my ability to earn a living. So I had a special policy called an own occupation policy, and that paid for me to go back to school for 4 years and learn everything that I could. And I went back and got a chartered financial consultant designation, a chartered life underwriter designation, and a chartered special needs consultant designation. And I really, really loved learning all of this wonderful new information. And right around the time when I was just finishing up that career in music, or just winding it down, I should say, I came across one of my favorite subjects was Austrian economics and Austrian economic theory. And what that is, it has to do with why prices go up and down and inflation and the money supply and all of this stuff that I thought was really fascinating. So I went to hear an Austrian economist speak. His name is Robert Murphy. And lo and behold, he laid out the case for infinite banking in such a clear and concise way. And I had no idea what it was, but that is what I was really drawn to understanding thoroughly. So what infinite banking is, it is being able to have a line of credit that when you borrow against it, it does not increase the money supply. All right, so the problem for investors, I work all over the nation with real estate investors specifically. That's who I am best geared towards, and that's who I can help the most, because real estate investors are really, really unique people. Their mindset is different. Their mindset is, hey, I want to be in control. I would rather be in control of my future than handing my future to somebody else. Would you agree with that?
I couldn't agree more. And I'm so glad that you walked right into it, because that was going to be my next question. But I want to take a step back, because I do believe that, your reflection of, your operation, your business. And I think it's just, I don't want to let this, this really powerful story slip through the cracks. I think it's really important to highlight that, you literally had to face adversity in your life that kind of made you really go deep into an area that you needed the most. And so I'm very curious, because I heard the you going back to the school part. Now I just want to make sure that I give some context here. So the policy, because I wrote it down here, its own occupation. Is it an own
disability? Disability.
So let me ask you, because this happens all the time, right? Insurance, y'all get it until it happens. Now you really need it. At what point? It's the same thing. And I'll say too. Yeah, well, banks give you money when you don't need it, right? Or vice versa. So let's talk about this for a second. This disability policy, is this? I want to make sure I'm saying everything correctly.
Yes, you're saying it perfectly.
Okay, fantastic. Yeah. This disability policy, is this something that you had in place prior to the event, or is it something like, oh wow, now that I've come across it, I need to get it? Because I think it's important for our listeners to hear that.
That's a great question. And what it is that you have to have that type of insurance in place before an event happens. So there can't be a pre-existing condition. You have to qualify based on how much money you earn is the big thing. And the second thing is, what occupation are you? So, for example, I was a recording engineer who was making my living using my hearing. All right. And so what own occupation means is that if I'm unable to do that job, but I'm able to do another job, it still pays. All right. So there's a lot of jobs that you can do without perfect hearing. I just had partial hearing loss, right? There's a lot of jobs you can do without perfect hearing, but this policy paid off tax-free for 5 years. And what I used that time frame for was to go back and learn another career. So it was really a valuable resource for me because honestly, I don't think I would have went back and learned an entire new career if I had to continue working to support my family. There's no telling what I would have had to do. Does that make sense?
Absolutely. And
yeah.
I think it's important to preface by, one of the questions I had was, so it sounds like you had this policy in place before.
Yeah, it was, I put it in force in, I believe it was 1992, and I didn't use it until 2012.
Okay, so can you walk us through that? Like, how did you, because I think it's important for us a lot of us are in the, real estate entrepreneurs, we're playing a lot of offense, not so much defense.
Yes.
At what point, so just so our listeners can really think about this, whether you're driving, listening to this, whatever it is that you're doing, just take a pause for a second, listen to this, how important it was for Tom to have this in place before it happened. But give us a little bit of like an idea of like what made you, I don't know if you said, did you say 92 you said?
1992, yes, 92? Sir. That's when I bought the policy, yeah.
What made you buy the policy? Were you persuaded? Did you have someone in your colleague? What was it that made you get the policy?
It was a financial advisor who said to me, you're making quite a bit of money in the music industry with your hearing. And if you lose that hearing for any reason, you will not be earning this kind of money. So you really need to protect that income. And there is a specific product designed to do that. Honestly, it's one of the most under-owned and least understood financial products out there is disability insurance. And anyways, that's how I was able to go back and learn all that I know now. And I'm just really excited about sharing with people. Really, that doesn't have anything to do with infinite banking, okay? Yeah. But I want you to understand that I've come up with my own concept called bulletproof wealth. And Bulletproof Wealth incorporates this disability protection with infinite banking. So I combine a lot of different elements to give you a more holistic approach to protecting your wealth so that no matter what happens to you, you're going to be okay. And the way I like to put it is, hey, this is not a get-rich-quick scheme. It's a hopefully you'll never be poor scheme. Does that make sense? Because at least if you lose your ability to earn a living, this will pay, right? And also inside of the infinite banking concept, which has nothing to do with disability insurance, it's a whole nother thing. It has to do with creating a line of credit in specially designed mutually owned whole life insurance. So that is what infinite banking is. It's a whole different thing, but I combined those two things together to create the bulletproof wealth strategy.
Okay, so this was so important for us to understand. I'm taking a lot of notes already. You're filling up my pad because that's what we do here in the lab. So let's unpack this thing because I think what you've done here is you've given us some great context, right? But
yeah.
I want to lay the foundation even a little bit more. For those who are listening who are not familiar with infinite banking, can you give an idea of what a traditional infinite banking model looks like, or what it even is, so that then we can understand the twist that you put on now that you've pretty much made it very clear of how you've kind of model the disability policy. So we're going to keep that on the back end, and then we're going to add the two together. So let's talk about infinite banking. What is it for someone who's never heard of that before? What does that mean?
All right, infinite banking. So the best way for me to describe it is to talk about a home equity line of credit for real estate investors. Yeah. Pretty much everybody has heard of a home equity line of credit and understands just the basics of how that functions. So let me just encapsulate it real quick. What a home equity line of credit is that you have equity inside of some sort of asset, in this case it's your house, and the bank lets you borrow against that equity. You're not borrowing from the equity, you're borrowing against the equity because your equity your house stays there. right? You're just collateralizing that equity. So collateralization is a really important term that, needs to be completely understood, and that just means that that's what you're putting up as collateral in case you default on the loan. Then they come and they take your house, because that's what a home equity loan is based on. So the cool thing about a home equity line of credit is that your house is still there. If the market appreciates, your house goes up with it, but you're still able to access a portion of the equity, whatever the equity is, depending on what your loan to value is, right? So there's a couple of problems that I love solving for people with the home equity concept. Number one, big problem is that your house is not guaranteed to go up in value if you got a home equity line of credit, because as we all know from 2008 and 9, houses are not going to go up forever guaranteed. It just doesn't work that way. Now, we are in a really hot market right now. And it is true that the prices are going crazy right now, but are they going to be there going the same amount of crazy next year? We have no idea. It's not guaranteed, right? So there's one thing is your house is guaranteed, not guaranteed to go up in value. The second thing about a home equity line of credit is that the interest you pay, it goes straight to the bank. Do you own the bank? Answer, no, you do not, right? You usually get a home equity line of credit from a bank that you don't own. So the interest just goes to them, and that makes the bank wealthier, right? And this is the biggest element with a home equity line of credit that the infinite banking thing really addresses, is that if you had a $500,000 house and you got a 90% loan to value on it, if you had no loan, that would be a $450,000 home equity line of credit. It does not matter what your house goes up to over the years in value, that home equity line of credit is not going to get bigger on its own. It's just going to stay at that $450,000. Does that make sense?
Yeah.
It's not going to keep going up. The only way to get access to more of your house's collateral is to go back through the whole appraisal process, the whole loan process, get reapproved, pull your credit, and then eventually you can get access to a larger line of credit. So what infinite banking does is it seeks to create a similar product to a home equity line of credit, but you're using the collateral is the equity inside a specially designed life insurance product that is guaranteed to go up in value every year by contract, number one. Number two, the amount of equity that you have access to goes up every year. And number three, when you pay interest, you're paying it to a company that you're a mutual owner of, so they are required to return part of the profit back to you in the form of a dividend. So they take all the company's profit, and then including any interest payments you make, and then they take out their company expenses and mortality charges, and then the rest of it they return in the form of a dividend. So it's actually a really unique concept. Now, how did the guy come up with this concept? He came up with it because when you take a loan from an insurance company, they have, and this is going to be a little technical, but it's called a 1-to-1 capital reserve ratio. That means that if you took a loan for $100,000, the insurance company has to reduce their balance sheet from their general accounting balance sheet by $100,000. Right? There's no magic going on there with insurance companies. They just take $100,000. If you borrow $100,000, they have $100,000 less. I don't know if you have heard this. Have you heard much about fractional reserve lending? Do you know what that is?
I'm not familiar with it.
All right. Fractional reserve lending means that when you deposit money into a bank, they can take a small portion of that, 10%, leave it on reserve, and then they can loan out way more money
yes.
than you put in. So
yes,
if you put
in simple words, just to help our listeners, it's basically the money that's in your bank. A lot of people say, "Hey, can I just take out my $1 million?" Well, no, because it's being lended out to. There's a limit, right? I mean, you can't just be extremely liquid. That money is being lended out, and so yes. So I'll let you speak.
I know I said a lot there. Yeah.
Yeah, but I want to definitely give some context to people. And I'm glad you're touching on it from an expert's level, because I know there's a little bit more to it. So please carry on.
So what it basically means that if I deposit, believe it or not, this is how the banking system works today. If I deposit $100,000, the bank can lend out $1 million. That's just unbelievable. Now the question is, where did they get that 900,000 from, right? And the answer is that is part of what's called the banking charter that they have. They have access to what's called fractional reserve lending. That means that they can lend out more money than they have on deposit. So that is why this guy, Nelson Nash, came up with this concept of infinite banking, because he knows if you're saving your money with a life insurance company, they don't have access to that multiplier. And so it's a 1-to-1 capital reserve ratio. And you might say, why does all this matter? This is all sounds like a bunch of hyperbole, like it's just, you're talking about economics. Here's what it is. What is the definition of inflation? The definition of inflation is an expanding money supply. That's what a true definition of inflation is that there are more dollars creating the same amount of goods and services, which causes the prices to rise. Now, a lot of people will say, oh, inflation means rising prices. That is not true. That is the outcome of an expanding monetary supply. Okay, so that's the result of more money being created, chasing or trying to buy the same amount of goods and services. So what this does is it solves the problem that Austrian economists have had forever of, hey, how can we keep inflation in check? So the more people that take advantage of this concept, you're actually preventing the dilution of your own money supply at the same time as providing yourself some unbelievable benefits. So it's pretty cool.
Okay, so this is really interesting because, so let me ask you, if I'm listening to this, I'm like, okay, Tom, that was great. And that's a lot, right? That's a lot to handle.
Yeah.
It's fantastic, but it's important. It sounds like what you said was like at a macro level, what's happening.
Yeah.
Now,
yes.
What about the individual, right? Because a lot of us, we're going to battle, we're going to war for our
yes.
we're trying to build our investment portfolio.
Got it.
It sounds like that was a very good idea of like, okay,
the theory.
Talk about the theory and really the reality of what's going on, right? People are talking about stimulus checks. Well, that's fantastic, but really, it's the value of the dollar. I mean, if you're printing out money, the value of the dollar is gonna,
where did the government has no ability to create money? To create value. All they can do is, print money, and that money is backed by really nothing.
So it used to be by gold before, right?
Yeah.
I think when Nixon
prior to 1971.
But no,
right?
That's
they
no
took us
the
off
case.
that. No, that's not. And they now call it fiat currency, which fiat means by decree. So they just declare it to be in existence and boof, there's more money. Well, if you have more money every year and the same amount of stuff, then the stuff has to be going up in value. It has to be costing more. That's just how it works.
Yeah.
So anyways, that's the true cause of inflation.
So
anyways, this is what, it's a lot of economic theory to boil down what infinite banking is, but in reality, real estate investors have to save their money somewhere, right? And so where do people save their money when they're trying to take advantage of a deal when it comes along? Because as you know, you have to be in a position to take advantage of a real estate opportunity if it comes along. Most people are saving money in traditional banks, okay? So the big thing that I teach people is that, honestly, I teach people how banks make money and why you would really rather be in the position of making money like banks do if you had the option, right? If you understand how banks make money, then you'll realize, wait a minute, is the bank really your friend here? So let me give you an example. If you deposited $100,000 into a bank, does the bank consider that an asset or a liability on their balance sheet? What do you think?
I would say a liability.
It is a liability because they have to start paying somebody who deposits that money interest the next day, right? And banks do not make money by paying people money. They make money when this next guy comes along and he takes a loan from the bank, right? So when a borrower comes along and he takes a loan from the bank, now that is the asset. Now it's backwards from what most people think, right? Most people think if you took $100,000 down to a bank and you deposited it in the bank, that they would consider that an asset. They'd be so happy to have that money. But in fact, no, it's not till they put that money to work do they make any money.
Well, I think
does that make sense?
Absolutely, and I think my listeners can probably connect with this. I work with a lot of hard money lenders, and which you
totally
are familiar. And I was
yes.
speaking with one who lends a lot of money. He's like, I don't want to get my money back, Ruben. Like, and it's just so fascinating because, and the idea is, guys, this is for us who are borrowing hard money for fix and flips. Really, I mean, you're paying those high interest payments, so they want to lend that money out. When you pay them back, that money's dead, right? They don't want that.
Right.
They want that money to work for them. So I think,
and so guys, if you have money sitting in a traditional bank, okay, you're earning what I like to euphemistically call 0 point nothing interest, okay? That means that they're really not paying you anything to speak of, but add insult to injury, that money that they pay you on interest on your deposited money is also taxable as your ordinary income bracket. So let's just say, back to the $100,000, if you deposited $100,000, after one whole year of you doing nothing with that money but waiting for a real estate deal to come along, the bank would be required at 1/4 point to pay you $250. Well, that $250 for the use of $100,000 would be taxable income to you. So you have to tax that at your ordinary income bracket, which is the highest tax rate. So you're really getting no advantage except for liquidity, which means accessing the money without losing the value, right? So if a borrower came along and was willing to pay the bank 5.25%, and the bank had to pay you 1/4%, what is the bank making on a rate of return basis? That's what I love to get to the bottom of with my people, with my clients, and teach them this stuff, because when they understand how this all works, their mind starts spinning with, oh my goodness, most people listen to that and they say 5.25% is being paid to the bank. The bank's paying out 1/4%. The bank must be making 5%, right? So that is what most people think, and it's just like cracks me up because they're not really understanding the numbers, right? The numbers are, put dollars to it and the light bulb will just turn on. If the bank is paying you $250, but some guy that's taking a loan for that same $100,000 is paying the bank $5,250, that ain't 5%. They're taking $250 and turning it into $5,250. That's a 20x return on their capital, meaning that's a 2,000% return that the bank is making. Why? It's because they're not using their own money. They're lending out the money that you have on deposit. The bank doesn't lend out their own money. So what I'm doing with infinite banking is putting real estate investors in a place where you're building money up inside of a specially designed whole life insurance policy. It gets larger and larger every year. And then when you take a loan, you're not taking money out of your policy. You're using that equity to collateralize a loan against the value of your policy at a low interest rate. You go out and do hard money lending, fix and flip, whatever you want to do, and you're earning a higher interest rate than what you're paying the insurance company, and voila, you're making money just like banks do. Does that make sense?
It does, and I want to unwrap it because I think you said a keyword, and it was liquidity, right? And that's
liquidity,
really
yes, sir.
I think liquidity for everyone is like, okay, it's access, I can get to it. But we're not even thinking about the long term, and I loved how you explained that, because that 2,000% return is just like bonkers. So we already knew we already knew the banks were our friends, but we didn't know they were just hustling us, right? Let's just be honest.
Yes, that's why they give you a dum-dum on the way out the door.
Yeah, right, exactly. Wow, I love that. Wow, that's got to be a quote. That's gonna be. We heard it here first. I love that. But yeah, because we're the fools here. So now that we've acknowledged the, and I wouldn't even call it, I don't even know if it's an elephant in the room. It's been in front of our face. I think lot of us investors understand the power of leverage. So that's why
Yes.
we do on it. That's when you ask me, offline, well, I think we're more net worth driven, right? Not so
Yes.
much cash driven, which is great. I think it's a step
Yeah.
up, but we're still doing things traditionally incorrectly, myself included. So let's talk about how we can make that shift, because
Yes.
and I love how you said, because it's like, okay, we know this is not a good idea, but how does it really look like? And I love the $100,000 example, because that
Yes, sir.
you can kind of see it. What does it look like when I want to come into your ecosystem about
Yep.
this product? That's, I'm gonna call it a three-headed monster, by the way, because this is just fascinating. How
Okay.
does that look like when I want to work? I want the three-headed monster to be on my side for my next
Yes.
deal. What do
Oh,
I
that's
do
a great question.
next?
All right, so here's the way it works. Number one, it looks different for every single individual because the factors that go into it are A, how old are you? B, how much money do you earn each year? Those two things determine your insurable interest. And that's just a fancy term for how much life insurance can you qualify for. So let me just break that down. The younger you are, the more you can qualify for. As you age, that number goes down and down and down and down until eventually at age 70, you don't qualify for any more life insurance. You're done, right? So your eligibility starts at 20 and it ends at 70, and it's based on your income, right? How much it costs to do this depends on your health. Okay, so at any age, people can be unhealthy at 25, 35, 45, whatever, or they can be super healthy all the way until they're 70. So the amount that you can qualify for in terms of a face value, they call it, in other words, like how many millions of dollars of life insurance do you qualify for, is strictly based on your age and income. So let me give you an example. A 30-year-old making $100,000 a year would qualify for a 30x multiple or $3 million of life insurance. Okay, so that's how much a 30-year-old would qualify for, just as an example. And how much?
And I'm sorry,
Yeah.
Tom, because I want to make sure that we're as you're giving so many gems, I want to make sure that we're building a foundation as you're speaking.
Sure. Yeah.
Because you're so knowledgeable. So 3 million.
Yes.
When you say qualify for 3 million, what does that really mean? Does that mean that as soon as I buy this policy, it means if something happens to me, God forbid, there's 3 million there, that's there if I'm no longer around? Like, can you?
That's right.
Can
That
you
means it would
quantify
take
that
care of any beneficiary that you designate. Would get $3 million tax-free if something happened to you. That's what the $3 million means. It's not you have $3 million that you can borrow in terms of a loan or anything like that.
Right.
It's that is what the insurance company is literally guaranteeing that they will pay out to whoever you want. You know, it could be a charity, it could be spouse, children, anybody. You can choose whoever it is, and you can change that, by the way, anytime you want to. But the point is that's what the $3 million is. So let's just say, for example, you were 30 years old, earning $100,000, and you said, yes, I want to do a $3 million policy. Now, this is what I do. I reverse engineer the policy. Normally, what happens is people say, I want to put in the least amount of money for the most amount of life insurance. That's how people normally think of it. Least amount of money, most amount of life insurance. I reverse engineer that completely and go, okay, I'm going to teach you the benefits of putting the most amount of money in for the least amount of life insurance. So the first thing we have to do is determine your eligibility for being able to do this. So if I said, okay, you're 30, you make $100,000 a year, you can qualify for $3 million. Now we have to see how healthy you are. The main factor on health, believe it or not, is your height and your weight. That's the main thing they look at. Because if you are they call it a BMI index, body mass index, right? If you're overweight dramatically, that's going to cost more to insure yourself, right? And so the healthier you are, determined by your body mass index and any prior health conditions that you have, the less expensive the life insurance would be. So for example, with a term policy, you might be able to get a $3 million term policy on a healthy 30-year-old for, I'm just guessing, $800 a year, maybe $1,000 a year, right? So I don't know exactly. These are numbers I'm making up off the top of my head, but I might be able to structure an infinite banking policy to put in $30,000 a year for that same $3 million death benefit, right? So I'm just going from 1,000 to 30,000, and somebody would go, why in the world would I want to do that? The reason is because you're building this wonderful cash value inside of your policy that you can then collateralize and have a line of credit, guaranteed, by the way, access. They cannot turn you down, so there's no financial requirements, no credit pulls, no nothing when you get this loan. It just comes to you in the form of a direct bank deposit within 5 days of you requesting it, right?
Okay,
so
wow. This is so good, and I'm so glad. I'm so glad. Like, you, honestly, you've been so patient. I can see you just trying to, because you understand how complex this can be, and I think you've done such a good job of bringing us here. Like,
sure,
guys, are the dots connecting? Like, if first of all, you have the luxury of going back if you need to, right? But I hope that you're connecting the dots, because my light bulb just went bing, like, got it, right? So just say that one more time, just so we understand, because I think people didn't understand the long-term play here. People for policies, right? A 30-year-old, right? And it has a $3 million policy, typically would say, oh, let me put the least amount so I can get the most coverage for your life. And you're flipping the script. That's what Tom is doing.
Exactly.
He's saying, no. You're going to do the opposite, because there's a little magic at the end when you do that. And please correct me at any point if I'm incorrect.
No, you've nailed it.
My light bulb went off.
Yeah.
He's gonna do the opposite, but he's not. He said 30,000. You're like, well, why in the heck would I do that? Well, listen to this spread that we're gonna literally unravel here. $30,000. That's saying, again, guys, this is just a number, right? With respect to your body mass index, how much money you make, and your age. Now, you have access. Like, this is a whole collateral thing, right? Of taking a loan against the. So let's build on that. There's $30,000 that you've put in, and you're aggressively investing into this policy. Let's talk about the magic that you can do now that it's in there.
So this is the thing, is that you start an uninterrupted compound growth stream inside of that policy, because it pays dividends every year now for the rest of your life, and you can still collateralize it to loan against it. So hard money lending, this is what I love to do, private lending, and I have a whole example of how exactly I did this recently. But the bottom line is that I just did a recent loan, private money, for $125,000. I used my cash value as the collateral source, right? And I lent the money out at 3 points for closing and 1 point per month, right? So I got basically over a year, it's a 12-month loan, I got $18,750, right? How much did that cost me to get? It did not cost $125,000, because I left the $125,000 in my policy. It only cost me the $6,250 of interest that I'm going to have to pay over those 12 months, right? So what I did was, a normal private money lender would be earning 15% in that scenario, and I turned it into a 200% rate of return by employing my own strategy. Does that make sense? I'm not taking $125,000, I'm taking $6,250 of interest to make $18,750 of interest, and now I'm making money like a bank does. And that's what I'm doing. I'm helping people understand positioning your capital is the most important thing to make money like banks do. And that is, you have to position it in a place where it can continue to grow and you can have access to it In this case, collateralized access to it, guaranteed.
Okay, so now I understand why you're trying to go on a gazillion podcasts and like scream at the top of your lungs, because no, I mean this is it's
Yeah.
interesting because they say, right, when you have a good product, because people, so we talk about sales, right, and you don't need to like, it is your duty and obligation to let the
Yeah.
world know when
Yeah, that
you
this
have,
exists.
it's your duty. It's like, I'm selfish if I don't tell this to my next family member. What am I doing, right? Like,
Right.
but obviously the thing is, chains of habit are too light to be felt till they are too heavy to be broken, right? That's a Warren Buffett
Right.
quote.
Yeah.
How we'll hear this, and I know half of the listeners, they'll know, but like, I don't know, it just seems to like, oh no, go back to the own ways. Can you talk about uh, the importance, if it hasn't been made clear enough, of how much you're really not benefiting not only yourself but the people that you love? Like, how important is it to do this, and what are the, I guess, the, how much does it cost you not to do this? Let's put it that way.
Well, it is a really interesting thing because this thing that I do is so misunderstood. I mean, it is ridiculous how misunderstood this is and villainized. Okay. It is, in general, the concept of buying whole life insurance is a villainized concept. And Ruben, I just don't know. The reason I think it's villainized in the end is because it pulls people away from investing in the market, and the market investing is just where the general population is putting all of their money in the market. And the competition for not putting your money in the market is strong. They try to villainize anything that doesn't allow people to just put that money in the stock market. And so I will tell you, that is why I only basically work with real estate investors. That's it, because they're the one group of people that say, you know what, I'm not brainwashed into thinking the stock market is the only place I can put money. I know that I can do real estate, right?
Absolutely.
And so this is just giving you a structure, a place to save money for the long haul that ends up providing you unbelievable benefits for your family. It gives you unbelievable tax advantages that nothing else has. So the limit, by the way, on that $30,000 a year example, the reason I limited it to that was because the way I design these things, if you went to $30,001, it would turn into what's called a modified endowment contract, and you would lose the tax advantages. So what I'm seeking to do is to put in the maximum amount of money that is allowed by the IRS for this to still be called life insurance.
Ooh, okay, cool. So that amount, okay, that's very important. I hope you guys are still listening here.
Yep.
Okay, that 30,000, was that an arbitrary number, or was that actually?
It is. It's an arbitrary number, but I'm just saying that is when we were looking at it as an example. It's some sort of number, and it's based on your age and your income and your health.
Okay,
so everybody's numbers are different, right? And that's why the one difficult thing I have with this talking to people is that you can't really talk about this generically other than conceptually, because everybody's numbers are totally different. Literally, your numbers are going to be different than your brother's. Your numbers are going to be different than your friends. It just is, because everybody has different health challenges. Everybody has different income. Everybody has, there's just too many variables for me to go, yes, you can do this number based on this number. It's like, I can't do that. I have to look at it. Which is why I have a huge library of educational videos that are totally free for people to learn about this. And then I have a very structured way of creating a customized plan for each person to see if it would be a good fit for you. And I'm not at all aggressive about this. I just help people understand it, show them their numbers, and then to see if they're interested in doing it. Does that make sense?
Absolutely. I love how you always ask that. Does it make sense?
Yeah.
You come from a teaching
background. So that is stressfreeplanning.com is where people go to do that, and they can learn about this in a really low key, non-threatening. I'm not going to be calling you and bugging you, any kind of thing like that. So I love teaching, and the way that I found to be the most effective is to have an online video library that's not available on YouTube or anywhere else. It's only inside of my website, and you just put your name and email in to get access to these free video content. That's the way that I decided to do it, and it's been very, very effective.
Absolutely. So what would you say, is the biggest misconception with this concept that because I want to unravel the
That's a good question. So the biggest misconception is that the evil insurance company keeps all of your money. Okay, that is what's been propagated out there by the Dave Ramseys of the world, is that, oh, the insurance company keeps all your money at the end of your life. Well, that's absolutely not true, because the thing that people don't realize, and this is what it just drives me crazy when I hear these statements being made, but the reality is that the face value of your contract increases each year. So you might start with a $3 million face value at age 30, but by the time you're 67, it might have grown to 6.5 million. All right. So your equity grows, but so does your face value. And the equity is what you can borrow against, right? And yes, the equity does not return to you on top of your face value. So if you have a $3 million in equity and a $6.5 million death benefit, if you pass away, you're not getting the equity and your death benefit. You're not getting $9 million. In the same way, if you sold a house that was worth $500,000 and you had $250,000 in equity, you're not getting $750,000 for that house. You don't get the sales price of the house plus the accrued equity. It's ridiculous, but it's just that people don't understand what the cash value is. It's equity.
So
does that make sense?
Absolutely. And I, right before we wrap up, I want to make sure we talk about the other side, because someone might be listening. Okay, great. If I had a banker in here, he'd tell me what's beneficial for the bank. Or
exactly.
Excuse me, for the consumer, not the bank.
Yeah.
So I always say people can't do business with you if you don't understand how you make business work. So how does the insurance policy companies, or the insurance companies, I should say, who own the policies, or technically the consumer owns the policy, but you know what I'm trying to say?
Yeah.
How do you monetize, right? Because that's important.
Yeah. So that's a great question. The only way that I make money, I don't make money on education. I don't make money going through these plans. I make money if you decide to put this in force. The insurance company pays a commission to be able to do that. And all of the numbers that I show people when I'm showing them exactly how this works are net, meaning after all the insurance company's fees and any kind of commissions is paid or anything. So if the numbers look good to you, just know that there's no gotcha. There's no, oh, if you sign up and book a call with me, I'm going to charge you $5,000 to create a plan for you. It doesn't work like that. It is net numbers are being shown to you after all insurance company fees, commissions, and everything. And it works. And people love it. It works after the fees are stripped out. Obviously, because it's a financial product, the insurance company is making a profit doing this, right? Because they have to guarantee that death benefit being paid or the face value being paid to your beneficiary. So it's not a free thing. But I will tell you this. After about 7 to 9 years, depending on how the policy is structured, your age, and your health, you have all of the same amount of money you've ever put in is available to loan against, and that money keeps growing and growing and growing and growing and compounding to where by the time you're at retirement age, you usually have double or 2.5 the amount of money that you've ever put into it. So it has a lot of internal cash accumulation that you can do with what you want. It's like, it provides also a tax-free retirement income that is just mind-blowing when you look at how it's structured. Again, I don't want to go into too much because there's a lot of detail to how it's tax-free, but it works just unbelievable. So you can retire on this plan as well.
I love that. I mean, and what you've done here, I think, Tom, the entire, preface of this show is to plant the seed, right?
Yeah.
And then you gotta pour more on it. So I think right now what you've done is planted a seed into some of us, ignited a light bulbs, if not a few. And what I'll ask is, now that you've kind of, brightened up the path to this new door that we didn't know existed, when we open up that door, we want to figure out how we can get more in touch with you. Where can we find out more about the different rooms that there are in this door
Sure.
that you've opened? Again, excuse my metaphor, but I have to do this. It's just,
no, it's
so
good.
enlightening. So where can a listener say, okay, this has gotten my attention? Obviously, experimenters need to educate themselves a little deeper. Where can they find out more about this and how to
All
work
right,
with
so
you?
there are two primary resources for this. It's infinitebanking.org is kind of an official like sanctioning body, and you have to go through training, education and stuff, and there is a practitioner finder there. And of course, I'm an authorized infinite banking practitioner on top of being a all the other designations I went over at the beginning of the podcast. But I specifically have a website called stressfreeplanning.com, where I have a ton of educational podcasts. I have resources, video education. I have the original developer of this concept teaching a course on it as well, so that you can go and immerse yourself in this. And then when you book a time to talk with me personally about it, prior to our call, I send the thing I love is this book called The Case for IBC. So if you don't already have that book, I'll send you a copy to read before we talk, because that really does turn on the light bulb for a lot of people as well. So it is a really effective education system that you have access to at stressfreeplanning.com. And that is really what I do, is I educate first, and then if it makes sense for you, then we move forward.
I love that, and that's a good tactic, by the way. And when I say tactic, I meant as far as it's a good way to work with people. I was just studying this, that if you give them your book before you come, it builds a foundation and builds rapport, and that's why podcasts like these are just as valuable as well, because now you have some rapport with who Tom is, how he's a beneficiary of his own practice, and how he's now dedicated time to help others do the same. And the best thing we can ask for is awareness and education, and we'll make sure we include that all in the show notes. If you're driving, keep your hands on the wheel, don't you worry, we'll include that in the show notes. And Tom, we cannot thank you enough for stepping into the lab and enlightening all of our practitioners for them to take a step towards their future in their lives, for them to actually make the right call and work with the three-headed monster.
Thank you so much, Ruben, for having me. I really appreciate it, and I look forward to talking to you guys again soon.
Absolutely. And just like that, we are out.